All right, now the expectations from the RBI's monetary policy today weren't really that there would be any tweaks to interest rates. They were largely expected to remain the same, and that is exactly what has happened. What everyone was looking for is how the RBI is looking at economic growth post the second wave. Remember, this is their first official statement after the second wave gripped India, and everyone wanted to see what the outlook is. So the FY22 GDP growth projection has been reduced to 9.5% from 10.5%, and that's overall the extent of the second wave impact. The governor also said that the impact has more or less been contained so far. If you break up how the RBI looks at growth panning out in the next 4 quarters, you can see very clearly that the RBI expects momentum and growth to recover and GDP to recover from Q3 in tandem, hopefully, with a better rollout of vaccinations. Those were some of the big highlights which came out from the policy, but another very important survey which was released separately on the RBI site merits mention. So the RBI regularly does these consumer confidence surveys. The one for May 2021, which was released today, shows that the current situation index fell to a new all-time low. Specifically, that means consumer confidence right now is an all-time low. Consumer perceptions on general economic situation and employment have lowered further. The future expectations index has also moved to the pessimistic territory for the second time since the onset of the pandemic. This is very, very crucial because if consumer confidence is low, if demand doesn't return, revival will get that much tougher. So a lot coming in from the governor's speech today and from the policy document. Another interesting point that was made was the governor speaking on cryptocurrencies, which has been the hot topic. Let's listen in to some of those key highlights.
Our circular clarifies the position very well. As you are aware, the Supreme Court set aside RBI circular, which was issued in 2018. But it came to our surprise that some banks were still referring to that and citing that circular in their correspondence with their customers. So therefore, we had to set the record straight that that particular circular of RBI has been set aside. So therefore, it is not at all correct to refer to that circular. And with regard to RBI's position, I have said it earlier, we have major concerns around cryptocurrency, which we have conveyed to the government. And with regard to advice to the investors, well, central banks do not give any investment advice. It is for each investor to make his own appraisal, to do his own due diligence, and take a very careful call with regard to his own investments. He has to take a careful and prudent call. The central bank cannot advise investors.
Rural demand is expected to remain strong as forecast of a normal monsoon bodes well for sustaining its buoyancy going forward. The increased spread of COVID-19 infections in rural areas, however, pose downside risks. Taking all these factors into consideration, real GDP growth is now projected at 9.5% in 2021-22, consisting of 18.5% in first quarter, 7.9% in second quarter, 7.2% in the third quarter, and 6.6% in the fourth quarter of 2021-22.
So what is the big takeaway coming in from the monetary policy announcement by Governor Shaktikanta Das today? What about projections for GDP growth for the next year? Can they really follow that kind of timeline? Most importantly, the relief which has been announced for contact-intensive sectors, is it nearly enough? To speak on some of these issues and points and the overall outlook for the economy, I'm joined today by Abheek Barua. He's the Chief Economist at HDFC Bank. Aditi Nayar, Principal Economist at ICRA, joins us on the show, as does our very own Mythili Bhusnurmath. Welcome to all of you, and thank you so much for speaking with us this evening on the India Development development debate. Mr. Barua, let me start with getting your take on the GDP projection, because that was the big number everyone was watching out for. It was largely expected there would be no change in rates this time around. So the GDP projection dropped by about 1%, 100 basis points for FY22. But the quarterly breakup is also interesting, which sees an upward projection, an upward revision compared to the last numbers in Q3 and Q4, telling us that perhaps the Reserve Bank is seeing the economy swing up after the third quarter. Do you share that optimism, Mr. Barua?
Not entirely. I think the projection that they have of 10.5% is kind of premised on what I would loosely call the best case. It's an optimistic projection, which kind of assumes that the hit to the economy because of the second wave is largely confined to the first quarter. And the revisions for the first quarter, I think, are fairly adequate. But then it sort of assumes no spillover going forward. And I think also builds in certain things like a ramped up vaccination program and so forth. So it's kind of premised, as I said, on assumptions which would be on the optimistic side of the spectrum. So I would, if I were to do a forecast, I would possibly do a forecast of between 8 and 10.5%, where that would be really the upward bound, the upper bound of my forecast spectrum. So I would tend to be a little cautious about whether this is really going to pan out.
Aditi, let's talk a bit more about the growth projections. In your view, do you think that the point that the governor reiterates, and it's been said before as well, that the economic impact after the second wave is not as harsh as the first wave? Of course, because there is no blanket lockdown for several weeks. These are lockdowns in bits and pieces. Do you think that overall it would be fair to say that the economic impact is not going to be that bad?
Thanks, Tamanna. So I want to also elaborate a little bit on what Abheek just touched upon. When we look at our own GDP projections for FY22, we've indicated a band of 8 to 9.5%. So what the RBI has indicated today, what the MPC has forecast, is in line with our optimistic case. And very much it seems to be premising that with accelerated vaccination, they will be able to get a resurgence in demand in the second half of this fiscal year. But I think where there is a little bit of disconnect with our own views is that if demand does surge back the way that it's expected to, then I don't think CPI inflation is going to average as low as 5.1% in FY22. Because what we believe at this point in time is that even though global commodity prices are high, because domestic demand is subdued and it's expected to remain subdued for a fairly prolonged period of time, therefore, there will be a limited transmission of the global commodity prices into the CPI inflation. So a 9.5% GDP forecast is somewhat at odds with a CPI inflation forecast, which is as low as 5.1%. So that's one thing that I wanted to point out. In terms of the impact of the second wave versus the first, I think the impact is differential across different types of economic agents. I agree that businesses have adapted. But these are big businesses. I don't know how many small or informal businesses or service providers have really been able to adapt, even in the second wave situation. And if we look at households, the consumer sentiment index number that just got released by the RBI today is actually showing us at a fresh all-time low. So we're now at a lower consumer sentiment number than what we were during the first wave. And I think this is coming back to the point that I was making earlier, that we do think that the impact of the second wave with a higher number of daily infections and with, a lot of death that people have experienced, in terms of the second wave. This is something that is going to keep demand subdued for a longer period of time, perhaps, than what we saw last year. There are categories where there was a bounce back, which would be the case in FY20. So we need to be a little careful in terms of how much demand we should expect will get will be announced.
So demand is one side of the spectrum. The other side is really the pace of vaccination. Mythili, if you look a little more closely at the quarter-wise projections for FY22, in Q3 onwards, you see that jump. 7.2% is what the RBI has said today versus 5.7% last time round. In Q4, it's 6.6% versus 6.2%. So the expectation is that perhaps by September or so, you would have a fairly large number of people vaccinated. Do you see that doable? And is that the key understanding and reading from what the RBI is saying today?
Unfortunately not, Tamanna, because the pace of vaccination rollout has been slow in the country, and we really do not have the supply tied up. Though the government has promised that by December of this year, we will get the adult population vaccinated and the 70% will be reached, so that we have herd immunity. I do not think the rate at which we are doing the vaccination, we will be anywhere near that. Economic revival is tied up entirely with the vaccine rollout. And I agree with Aditi that there is a serious disconnect between RBI's projection on the GDP front and the inflation front. If we are going to see GDP improve, there is no way inflation will stay down. We've seen inflationary tendencies all over the world. If demand picks up, this is going to feed in, given the excess liquidity sloshing through the system. So there is a serious disconnect between RBI's GDP estimate and its inflation forecast. Also, as far as GDP forecast itself is concerned, RBI has no independent source of determining an GDP for the year. What you have is what the NSO gives you, and then RBI does some modeling on it. And what we've seen with this virus is that it makes a mockery of almost every conceivable model that you can think of. So I would hesitate to make any firm projection at all. Maximum, you could have a band, which RBI has not chosen to do. They have stuck to that 9.5, which, as I said, is at odds with what they see on the inflation front.
You know, the other aspect I wanted to touch upon, and of course we've talked a bit about GDP projections and how they might be on the optimistic side from what the RBI is saying. But the other important aspect, and I think big takeaway from the policy announcement today, was support for contact-intensive sectors. Now, let me come to Mr. Barua with this. Measures have been taken in the past as well to support smaller businesses, if I put it that way, largely smaller businesses, MSMEs, etc., through extension of, credit guarantees. But for contact-intensive sectors specifically, do you think this is enough? I'm seeing the quote that you put out earlier today where you say a more equitable distribution of credit is likely to be contingent on whether the assessment of risks is in line with the markup over reverse repo provided by RBI to banks. Can you elaborate on that, Mr. Barua? What are your concerns there?
I don't think it's enough in many ways. For one, I think we need some kind of fiscal support for these contact-intensive sectors, because their problems are not temporary. They're going to be there for a fairly long time. It's almost like a structural problem for them, and they could do with fiscal assistance. Number two, I think the problem of risk remains. So even if you have an on-tap liquidity facility and you can lend to these companies in these sectors, whether you will be willing to do that or not is critically contingent on whether you think the markup over reverse repo that you're getting is enough compensation for the risk that you're going to take by taking an exposure to sectors that are going to be, chronically underperforming for a while. And really, it boils down to that. And my sense is that in a number of instances, there will, although the liquidity will not be will be available, there will be this little markup, but banks will be somewhat reticent about lending. One way to handle this, again, is to rope the fiscal side in and get credit guarantees, which, again, was done for some of the medical equipment suppliers, which initially got this, on-tap liquidity facility, and that it was kind of buttressed by the credit guarantee. So we need some kind of risk absorption mechanism as well for some of these sectors or companies within these sectors. Because I don't think the markup that you're getting on reverse repo, which is, say, you lend 100 rupees and 100 rupees that you park in the RBI's window, you get a slightly higher rate than you will normally get. So that's the incentive. So I don't think that's going to be enough. And I think we will need something like a full or at least a partial credit guarantee for a number of companies here. But again, I think, these are companies which will be in, I wouldn't say long-term decline, but certainly under long-term stress. And how we can sort of try and revive them or support them is a bigger issue than what, monetary policy tools would allow. And I think we have to think very deeply about the future of these sectors, because I think we are in a new sort of new normal where these would see a permanent contraction in demand.
No, absolutely. Monetary policy will have its limits there. Mythili, you want to come in on this point? Some of the contact-intensive sectors that the governor mentioned as part of his speech, including tourism, salons, spas, gyms, etc., who now have perhaps seen 16 to 18 months of strife with a few months of relief towards the end of last year. What is the need and urgency, in your view, to help keep these businesses afloat and make sure that the employment they generate is not all lost?
Which brings me back to my same point that I made earlier, that unless you have fear disappears and mobility is restored, you're not going to see much happening in these sectors. And that can happen only when the vaccination rollout is more aggressive, is more exhaustive, and we have achieved the required herd immunity. Till such time, you will not see a revival of these sectors. So as Abheek says, these sectors are in for a long period of trouble. Add to that the RBI monetary policy has its severe limitations in these matters. You can take the horse to the water, but you can't make it drink. However much liquidity you pump into the system, as we've seen for more than a year now, there are no takers. Neither corporates are willing to borrow, and nor are banks willing to lend. And in the case of the TLTRO, which has now been given for contact industry, we saw last time that they had given a similar facility for small finance banks. Bulk of it was not utilized at all, because the problem is not liquidity. The problem is A, demand for credit, and B, willingness of bankers to lend without that fear of it becoming an NPA. A guarantee is all very well, but if you've seen the difference in the way public sector banks have reacted and private sector banks have reacted, it will tell you that public sector banks, because they are owned by government, majority owned by government, have do exactly as they are told, and they lend and they say that's a great idea to have a guarantee. Private sector banks don't do it because they realize that just because the government says they give a guarantee, there's no surety that you get that guarantee money back, because as we've seen in earlier guarantee schemes, very often the guarantee is not paid for various reasons. And number two, you're not sure that they won't become NPAs. So for a variety of reasons, this is really not an answer. The fisc is the only answer. Monetary policy cannot do what it is not empowered to do.
You know, on the fiscal side, now let's move to what can be done then. And Aditi, I come to you with this. One of the suggestions which has come out today in one of the post-monetary policy notes is that cut the GST. Let the fiscal deficit expand a bit, cut GST rates, lower the rates of petrol and diesel, which are trending at three-digit marks and three-digit figures in a large part of the country, in many cities in the country. Do you agree with that these are some of the things that can be done immediately?
So I certainly agree that in a situation that we have right now that's unfolding, where we had the pandemic last year and we've had the second surge, which has been really unexpected in terms of its ferocity in 2021, the extent to which monetary policy can really help to prop up economic outcomes is going to be limited. And certainly there's a lot that's been done since last year by the MPC in terms of cutting rates and keeping an accommodative stance, as well as by the RBI in terms of all the credit measures that they've been announcing in a very timely manner. But perhaps to really be able to support demand, and it's really demand that we think is being impacted badly in the current situation, we do need to see more of a fiscal policy push than just a monetary policy push at this point in time. Having said that, the fiscal space is clearly limited, and whatever plan is made will have to be very carefully targeted toward the different sectors to make sure that we can get the maximum bang for the fiscal buck. And some of the things that could be looked at would include credit guarantees, for example, because clearly, as Abheek was saying, we do have liquidity which is available, but the credit risk still lies with the banks. So, that's one area that the government could look at. Second simple thing could be extension of the free food grain scheme if the situation demands it. So we've already seen this being announced for April and May, and if the situation doesn't improve, perhaps this is something that could be extended. And third, I suspect that given that the budget was made before the second wave of COVID, the amount that was actually allocated for NREGA may turn out to be lower than what is actually required for this year. So this is another area that the government could look at in terms of being able to provide some demand support at the bottom of the pyramid. But overall, whatever is done will have to be very carefully targeted. In terms of the tax side, I would go with cutting excise duties on petrol and diesel first, rather than cutting GST rates. I think it may be a simpler thing to do. It's also something that the central government would be able to do rather than GST rates, which require the GST Council to sort of move things forward. Perhaps this is something that would also be able to support our demand with disposable incomes being quite stretched the way that they are right now. And a very rudimentary calculation suggests that if the revenue in terms of the cesses on petrol and diesel, then perhaps we could look at a 3 rupee per litre cut in the cesses on these two fuels. It's not a huge amount, but it's definitely going to be something in terms of the benefit, the relief that it provides to the consumers when fuel prices are as high as they are. And it's also something that helps to reduce the inflationary pressure. So, it does sort of help in a dual manner.
I am going to take that point across to Abheek, though. On what do you think can happen on the fiscal side right now? Abheek, I talked about two possibilities, among others, a reduction in GST, for example, some kind of relief on petroleum prices and diesel prices, retail fuel prices. Do you think these are some of the measures that need to be considered now?
I think all fiscal options need to be considered, but I do believe that we don't have infinite fiscal space. So whatever fiscal stimulus that we provide would have to be very carefully targeted, and there are a number of possible claimants for and legitimate claimants for fiscal support. All these contact intensive sectors, for instance, could do with direct fiscal support of different kinds. We've seen all kinds of models emerge in other parts of the world that we can partly borrow from. For instance, there was this furlough scheme in the UK, which allowed a lot of the service industries to keep their workers on for periods in which there was a sudden, collapse in demand because you had containment or lockdowns or whatever. So something of this sort. But from what I could hear of Aditi, I think her point that you really need to be very careful about where you sort of spend your fiscal resources on, and ensure that it is really targeted to the segments that need it, is very critical. Certainly a broad measure like, cutting the GST and, giving up on some revenues on petrol and diesel will help possibly at the margin. But again, I think I would like to sort of go back to what Aditi was saying, and I think we should just sort of get hung up on this mobility growth link. The second wave of the pandemic is not so much about the impact of mobility, but it is the impact of morbidity, serious illness, which I think has debilitated the workforce and can have a permanent impact on productivity, and of course mortality. And both these things not only affect productivity, but I think they affect human behavior and certainly consumer behavior. So I think simultaneously, what has happened is that people have dipped into their wealth. We have data on provident fund used for tiding over emergencies and so forth. There's anecdotal evidence that there's been a lot of gold sales in the rural areas. So we are looking at a very different kind of landscape, if you like. Almost sort of a mental landscape of the Indian population post the second pandemic than it was at the first. So all this, the assumption that people will sort of suddenly rush out and there's this gush of pent-up demand that will prop things up is perhaps a little misplaced. So, we'll have to sort of think through these things, and maybe fiscal policy will have to dovetail into some of these issues that arise as we go along. And fiscal policy, for instance, can be used in order to sort of ramp up the vaccination drive or to ramp up healthcare so that there is a little more confidence in being able to handle another wave, another surge of infection. So again, targeting, to cut a long story short, is very, very critical.
I want to touch upon one more aspect in this conversation. Mythili, let me come to you on that, which is what's happening with the rural economy. Now, the governor was fairly nuanced in his commentary on the rural economy, pointing out that, yes, the spread in wave 2 in districts and villages and towns is concerning, but also saying that a normal monsoon forecast and rises in commodity prices also may, soothe over some of that hurt. What is your view on how the rural economy is going to pan out post second wave, considering it was huge support after the first wave?
Well, to be honest, Aditi, Tamanna, we really do not know at the moment, because we have very little information on what's actually happening in the rural economy. Yes, agriculture has performed very well all of last year, and this year also we've had a record food grain output. But the rural economy is much more than the agriculture economy alone. And given the fact that healthcare virtually does not exist at all in the rural areas, and vaccination rollout is dismal, it's virtually non-existent in the rural areas, we really do not know the impact of that on the rural economy. And given that it is the bottom of the pyramid that really does consumption, the rich don't consume, they already have enough and more of everything. So you are not going to have the rural economy doing well. If you're going to have sickness and morbidity in the rural economy, you are going to see the rural economy hit very badly. The fact that commodity prices are rising internationally, particularly oil, has huge implications for India for the inflation factor. So I really cannot think that we can stick our neck out at the moment and say the rural economy will manage to do okay. We do not know. I think we'll have to wait and see until the next policy. We get a little bit more information, but as of now, the signs are not very good.
Absolutely. There's still a lot up in the air. We can perhaps take heart from the fact that at least in urban areas, vaccination rates have begun to pick up. Vaccine supplies have improved to some extent. They have to stay like that consistently for the story to really change. I want to thank all of you, Abheek Barua, Aditi Nayar and Mythili Bhusnurmath, for joining us in the chat this evening.